All right, I got the recording. So the question was posed: Are we, uh, does it make sense to roll our? We have that short put spread that we put out earlier in Amazon, the 1745, 1750 for this Friday. Trying to, and we sold it for $2, and then what's going on, Cecilia? And then I think the revised exit was put out for $2. So I'm putting this out here in Amazon, 1745.50. Right now the market on it is $1.25 at 235, putting, it's a wide market. But the question was, should we roll this out, or does it make sense to? All right, and then like I said, the exit, I think put out one exit, and then you revised it to put it out for a break even, which I believe I saw some people doing. It looks like, let me bring up a chart here, pull this into here, and we can see, what we were. I'm not going to speak directly for Scott, but playing off of this support here at the 200-day moving average, which has been very much, a great place for support. You see 1, 2, 3, 4, 5, 6, 7, and then today it looks like it's a little bit below it. The markets seem heavy, and so the question was that instead of getting out for break even, are we better off rolling it out and rolling it out for a week and doing the same thing? Now, you can, and this is kind of where I got into that. I started by typing, and then I said, you know what, this is probably a better thing to talk about than anything else. And the whole thing with rolling is, now if you're really convinced that this is that this is a great play, there's no reason why rolling it would be a bad thing. Of course, you are going to generate more fees, and what we're going to have to do is essentially the roll would be, we have to buy this back in and then sell next week's, and is that reward to risk worth it? And I think the point that I want to make is, remember, and what I said before is, if you feel strongly about this Amazon, and I agree that if the markets do rebound, Amazon is going to probably, at the very least, I don't want to say lead the way, but it's probably, kind of as the markets go, Amazons go, and vice versa. The thing is what you don't want to get fixated on is, okay, I scratched, or maybe I lost a little bit, or maybe I made a little bit in Amazon, and now I want to get that Amazon money back. And my point is that you might be better served looking for a better opportunity. I mean, right now it looks like I haven't seen it trade anything other than the $2. I don't know if anybody has. Right now 180 seems to be mid-market, but we're talking about a kind of a wide thing. I don't know if anybody has bought this back for less than $2. But my thing is you don't have to get fixated on any one position. So let's say that we put something out in Facebook and we lose whatever. We bought it for $1 and we stopped ourselves out at 50 cents or whatever it is. A lot of people will take that trader mentality and take it personally. I got to make back that Facebook money. And that's not true. Your account doesn't care where you make or lose the money. It's just money. So that's what I'm saying. If you think that independently this is a great play, well, then you could do it again. So if we did this, and now we're gonna do the same thing to next week. So we're gonna buy this one back. We're gonna buy the 750s. We're gonna sell the 17.45s, and then we're going to go out next week and we're going to sell the same thing. There's so many strikes in Amazon. 17.50s, sell those, and buy the 45s back. So now that's your roll, right? Sell this week, buy the thing that we're short. Right now we can do that for about even. So which means that essentially we would be keeping most, if not all, of our $2 of premium that we sold it out at initially. So if you now realizing that doing something, we're doing it now for what, 8.5 trading days. We're going to be at risk for this too. So my point is not that this would be a bad trade, but you're generating fees, and you certainly took, there was a little bit of heat, and it's actually right now it's sitting below that big support. Market takes a dump this afternoon, that thing is going to go. So you have an idea. It was a great setup. It made perfect sense from a technical standpoint. It still pretty much makes that sense, but the market feels where it felt overdone after Friday's commentary from the White House. It really, we were up this morning. We're certainly not up now. Not that we're getting killed, but I mean, the market had its chance to rally and it hasn't. So how much do you want to put into this to be at risk for a long time? And again, it's a wide market. No, it's actually not that wide. I'm surprised it's that wide. Does that answer your question? I do not think so, Paul. Paul asked if there's any fills in the strangle swaps. I didn't. When Scott went up to his other office, he told me that there were no fills, and I haven't seen any reported. And then you can see that they are not in the watch list yet either. Oh, did? Is that a live fill, Barry? But I thought Scott said that it was out of range. That was one thing. I'm sorry, I was not. Let me see where that. I thought he said that there might have been some fills, but they were out of range. I'm looking here. And Tiffany's, TIF, it was valid. It was valid 83 to 86. And right now it's at 83.05. I don't know when you. So I'm not sure, but when I wasn't watching that one live, but when Scott left, he said any of those TIF fills were filled out of range. What should a strangle swap shape look like? Well, it's just it's a long call calendar and a long put calendar. So let's see the market right now. What are you trying to pay for this thing? 35 cents. It's 11 bid at 56. So it's valid here. I don't know if you buy that at 35 or not, but this is what the risk chart looks like on a strangle swap. These guys out of here. So this is what it looks like today. So you have kind of a long, not kind of, you have a long call calendar and you have a long put calendar. That's where he has it set now. All right, Dylan, let's see. If you put on, the question is, if you don't the profit or loss. So right now, you sold it at $2, and let's just say you could buy it back at $2. And if you did that roll, well, essentially what you're doing is, if you just look at, we know that the Amazon for this week, let's just say, because it looked like you could do the thing for about even. Maybe there's a couple cents on either side of that. Oops. And then next week, or excuse me, this week, we have to get out of this. Where'd that go? I said too many strikes. But at any rate, so then what you have is, this thing is 130 bid at 255, which puts right around $2. So basically, essentially what you would be doing is, and you can do the strangle swap for about even. If you were able to do it for about even or thereabouts, and that's not cool, about a dime on either side of it, then you would collect. And if it worked out for you, and you stayed above your strikes, and you let it go to expiration, you would keep that $2. Because if you think about it, okay, let's just scratch the one that we did for this week, and we can go out to next week, and we could sell that for around $2. So essentially, you would just have the initial risk that you had on, but you have it on until September 6th now. And you're asking about the correct valid range for Tiffany. Last thing that I see. Last thing I see is 83 to 86, and it's trading right there at 83. So Phil's came in here. Then they would, so now it's not valid because it's below 83. All right, any other questions on that, folks? And I'll render this video and get it out to you guys and all that fun stuff if you want to. All right, so if there's no questions, let me get the this thing stopped, and we'll get to it.